Hello and welcome to our latest investment strategy update. Growth is holding steady across the main economies with no evidence of a severe slowdown. The expansion is broad-based but not synchronized. While the momentum is strong in emerging markets and robust activity in Europe is still not generating price pressure, the first signs of overheating are emerging in the US and Japan. The two countries are indeed reaching full capacity. And to operate above potential, an economy must increase its resources, which in turn leads to higher inflation. If history is any indication, inflation should continue to trend higher going forward, and most central banks will have to manage the trade-off between growth and inflation as the economies transition from the stationary phase to overheating. Typically, the US economy is capacity constrained, scarce labor resources are pushing up wages, and inflation comforting the Fed's gradual tightening stance. But more monetary tightening is needed to threaten this economic cycle. Europe is far away from overheating thanks to significant excess resources, and in emerging economies, especially China, the recovery is on track. Stabilizing emerging market currencies and contained inflation have enabled easier monetary policies, and although these tailwinds are dwindling, they are unlikely to turn into headwinds. The global upcycle will eventually end, but odds are that its demise will be caused by economic overheating in the US amid rising financial and fiscal imbalances, rather than escalating trade protectionism.
We believe the positive trends in global trade should extend, and we see two major risk scenarios of our pro-growth stance. First, economic overheating, as Samy has just explained, and second, rising protectionism. The risk of a trade war is limited in our view, but financial assets will be impacted should tensions escalate. Under these circumstances, equities will require a higher risk premium, and the emerging and Japanese exposure will need to be drastically reduced. Investors' appetite for US treasuries will diminish, and European bonds will act as a safe haven asset. The US dollar will strengthen against the trade-sensitive euro and emerging currencies, as would the Swiss franc and the Japanese yen. However, the US and China seem open to dialogue, and a trade war is only a risk scenario. As a result, we keep our asset preferences unchanged and continue to favor European, Japanese, and emerging equities. The supportive macro backdrop makes it unlikely that market corrections translate into a fully fledged bear market. We maintain our sovereign bond exposure at a minimum, and we continue to see greater value in convertible bonds and emerging market fixed income. With the euro less undervalued and the US dollar stabilizing, our euro-dollar medium-term target remains at 125. We maintain our long yen position against the US dollar, as the Japanese currency is still significantly undervalued. As much as the global environment remains favorable to risky assets, agility and investment discipline are key with the return of a normal volatility regime. We will be closely monitoring the risk of overheating and protectionism threats, and we will keep you regularly up to date. Thank you very much for watching.